everybody. What's going on? I hope you guys are having a great day. Welcome to our Trade of the Week. TradersArmy.com. We're going to throw together our Trade of the Week on the TradeHawk platform, brought to you by Tradier. If you want to be an options trader, go to Tradier.com. $10 a month, unlimited, commission-free options trading. Super cool structure. Go take a look. Tell them TradersArmy.com sent you. But let's go ahead and take a look at our Trade of the Week. This week, we're talking about SPLUNK Incorporated, and I just love the word SPLUNK. First of all, it might be my new favorite company name of all time. But SPLUNK essentially provides software solutions that give enterprises real-time operational intelligence by harnessing data. That's really what they do. They're a data aggregator, and they sell this to enterprise-level solutions. Now, this company has, from a fundamental standpoint, their machine data platforms collecting and indexing, petabytes of data on a daily basis has not really been overly profitable onto their P&L over the last couple of years. Matter of fact, I took a look at investors.com, which is kind of where I get most of my fundamentals from. And SPLUNK, their ROE, return on equity, is 0% right now. Their debt percentage is 1,408%. And their overall, they're down about 21.67 year to date in their price. Point being is that SPLUNK is taking it a little bit on the chin. But how can I trade that from a technical perspective? So let's go ahead and take a look at the chart. So here's the chart of SPLUNK. And the thing I want to first pay attention to is very obvious to see that this year we've had a pretty strong move down. Now, it started in October of last year with a huge gap down. Big move down. Price came down here pretty hard. And then we rallied back up. So we rallied back up and essentially came back, not to the origin of the gap, but to where the gap had originally started, just about. Didn't quite close it up, but came just about to that region. And what I'm really paying most attention to right now is this area that we have down in here, where we've got this area of support, but this area of support at about 85.83, it comes very much in line with these two consecutive lower swing highs. Now, the fact that our lower swing high in this area here, and I'm just going to wrap some fibs around it, but the fact that this area down here, none of these areas down here, we're able to create enough demand to get us a new swing high. As I look at this, this area, we've hit it once, twice, 3 times, 4 times, 5 times. We continue to hit that area and unable to get a new swing high each time. So that is a very strong bearish outlook. Now, overall, let me get rid of some of these lines here. What does that look like on a longer term picture? So going back a lot longer term, here we see a bit of a weekly chart. And looking at this particular weekly chart, let me get rid of this here. Looking at this weekly chart, we can see that we essentially have a big head and shoulders pattern, right? It looks like a very, very large head and shoulders pattern. But I think it's realistic to believe that the next most accurate place that price would probably drop down to would be this region right in here at about $70 a share. I think that's kind of the most obvious stopping point for stock. So with that being said, I got to figure out what's a good options trade to take advantage of what I think would be the next move down. Now, we were really, really given a gift, if you will, by the fact that the market went up on Friday for this particular stock, rallying off the bottom, but unable to put in any additional strength, telling me that I wouldn't be surprised to see a little bit of a reversal up here, somewhere around this price area right here. I wouldn't be surprised to see a reversal at this area right over here. So with that being said, looking for a reversal in this level as price would come back down from this descending triangle, what options play would I choose? Well, the first thing I've got to do is I've got to look at my implied volatility. So I put my volatility channel out here. And when I put my volatility channel on here, we can see that we're in the middle range of implied volatility, which tells me that I should probably look to do a spread trade. So moving to my what if, let me put a new position here in Splunk. It's a Splunk bearish setup. And my underlying here is SPLK. And let me add an options trade. Now, for this case, if I can see up here at the top, I've got July 7th, July 15th, July 22nd, all the different months of July. So I've got weekly options in July. I've got the August options, the August expiration of August 19th. And if I take a look very quickly, I'm going to open up. I've got my August and my September. Those are the two that I'm going to pay the most attention to. Let's open up the open interest. Now, the open interest is important. Now, I want to have at least 100 contracts of open interest wherever I would happen to be trading. And as I look at this at the 95, which is, going to be a good enough position for me to get stuff moving my way. I don't have a lot of open interest at the 92.50s on the put, 74 and 60, but I got 280 and 405 in the August and the September. And then at the 85s, I got 383 and 1,046. So I should have enough open interest at both of them. Let me just look at the August. So we're going to buy the 92.50 put for, when I look at that, it's going to be $7, or not 92.50, excuse me. We're going to buy the 95 for August. If I buy the 95, it's going to cost me $9.10 a share. Now, selling the 85 is going to bring in $4.55. So in that case, I've got and hitting the mid is about $4.40. So in that case, on a $10 spread, I've got a cost basis of less than $5, right? So that fits my cost basis structure. Now, my belief is that price can make it all the way down to 70. So if I go to my table and I look at my table, and I take price even as low as 85, my P&L is at about 515. That's my max P&L is 515. So anything below 85 is going to be my max P&L of about 515. Now, how do I know I'm wrong? Well, I'm going to be wrong, I think, if it goes up above 95. So when I come back into my chart and I look at my P&L graph, if price gets above 95, that's where I take my biggest amount of risk and my biggest exposure. So let's take a look at this, not necessarily on expiration. Let's look at it. About 2 weeks before expiration, August the 5th. And at 95, if we go to 95, I'm risking about 90. Looks like I'm risking about 94 at this particular price level. My risk is about $143. If we come to our 70 price level, which is really where I anticipate price can go, our profit is 515. We've reached our maximum profit at that level. Even if we only make it down to 85, we've reached a profit of about 210.44. If we go down to 85, and essentially we've reached close to our max profit in that period of time. So I think that actually is a trade that makes a lot of sense, because our theta switch point, if you will, is below 89. Now, what I'm looking at there is once price gets below about $89 a share, every day that price stays below $89 a share is an additional bit of theta that we will collect. We move into what's called a theta positive position. And as I look at this yellow line being over the green line, that means that I'm in a theta positive position. And if I just play this out, you can kind of see as this moves further and further to the left, as my break-even line moves further and further to the left. So I think this actually works out to be a pretty good little setup. SPLK. We actually found it last week in our strategic trader class. For those of you that are members of the strategic trader class, had a chance to see that one. And so if you have any questions, as always, shoot us an email, support@tradersarmy.com. Until next time, everybody, hope you guys are having a great week. I will see ya.